The following program is sponsored by MaxOut Savings Advisors. The views expressed during the broadcast are solely for entertainment purposes and do not necessarily express the views of KNTH, its management, MaxOut Savings Advisors, or its sponsors. MaxOut Savings Advisors and members of the MaxOut Savings team may or may not hold securities mentioned during the show. Plan for your prosperity, prepare for your retirement, safeguard your savings, and nurture your investments. This is the MaxOut Savings Show with Ted Geoca, a presentation of MaxOut Savings Advisors. Now, here's your host from MaxOut Savings Advisors, Ted Geoca.
Welcome to the MaxOut Savings Show. I'm Ted Geoca, and we're talking savings, investments, and your retirement here on the MaxOut Savings Show. Our show is all about building up wealth and understanding the world today, understanding where we're going, where we've been, where we're going, and how you can profit from it, and how you can protect your wealth in these very uncertain times. We try to keep you ahead of cutting edge issues. We try to bring some very sophisticated things to the show so you can understand these issues. We make them very simple, so you can protect your retirement. Our show is all about saving money, investing, building up wealth. Our motto in philosophy is to save aggressively and invest conservatively. That save aggressively, invest conservatively. That's the key to building up wealth over the long term. Now, we like to start this show talking about this simple things because this is where it all comes from. This is where it all starts. This is where you build your base. And have some numbers here. Looking at the number, basically 1 in 5 people feel comfortable about their retirement. The numbers actually, when people retire, they're about 80%. They're happy, but the medium savings is age 55 to 64 is about 184,000. Now, the average is higher because there's some people with bigger money that skews the numbers. But typically, you need to save about 4.5 to 8 times your salary, depending on what you do. A quick number, the research has shown it's about 4.25% is what you can take out each year. Now, some people say you can take out a little bit more, but 4.25 is really and that, by the way, that grows with inflation over time. So that's not like a static number. If you've got $1 million, you can take out $42,500 for the rest of your life. This grows over time with your situation. So if you're behind, like 80% of the people are concerned, that age 55 to 60 is really when you want to start putting away money. Oftentimes, you're starting to get the things paid for. You're starting to get the college paid off. You have your house pretty well set. Now's when you can start putting away money. The government lets you put away an extra in your IRA, extra in your 401k. It's called catch-up phase because they recognize most people are in this situation. And as you get closer to retirement in your 60s, that's really where you want to, once you hit 60 and you're still working, you don't want to be traveling all over the world and stuff. You want to wait on that. You want to right now be putting away the money in the plan. So when you retire, you can do that if you want. Other people like to just do other things, but that's kind of the key to it is to build up that wealth, put away that money. And I came up with the kind of this is a real simplistic number. If somebody's concerned, oh no, I don't have enough to retire, and let's say they're age 64, they're thinking of retiring, they have $500,000. Well, it's if they save. Let's say they're going to retire this year and going to take out $22,000 out of their plan, that and some change. That gives them about 21 something, but say it's 178, 478,000 the next year. We're assuming the account doesn't grow at all, just for the simplicity of the explanation. And so they have about 478,000. Now, if they work another year, they could put away, if they look, we're really going to tighten the belt, we're going to put away a lot of money, we're coming near the end of retirement, they could put away 30,000. So at the next year, instead of having 478,000, they can have 530,000. It's an over 10% increase in their savings that they have right there just by working a little bit longer. And so that means they can take 10% more income out every year going forward. So something to think about if you look at these numbers, if you sit down with them, working an extra year or two, really putting away the money really changes your dynamic of retirement if you're behind. But remember, take charge of your retirement today. If you're behind, now's the time to go to your 401k, your 403b person, step up the retirement, start putting away the money. If you're at 10% of your behind because things were slow for a while or something happened, now put away 15, 20, 25%. Now's when you can do it. The government's giving you a tax deduction on top of it, so you're not even paying taxes on the money. So take advantage of that, take charge of your retirement, and build up wealth today. That's the key to the whole thing. So what do we have here? It's Groundhog Day every day with the Persian Gulf. The Persian Gulf, we had a deal. Everyone's heading over to Switzerland, and then there's war breaks out in Lebanon, and it's back to the drawing board, or not really the drawing board, but then the Iranians are claiming they've shut down the Persian Gulf, and this is going back and forth. And what's going on here? Some people aren't happy with the results. Look, no one's real happy. Honestly, this hasn't worked out. We didn't get good intelligence, obviously, on what was going to happen. It'd be interesting to see where the intelligence came from and what our intelligence agencies were saying on this whole war initially. And was the intelligence skewed to try to, lure us into this war? But so here we are. We have to do something with it. President Trump doesn't have a real good hand because the Iranians have kind of absorbed the blows, and they've been knocked back, probably 10 years in their business. But the problem is we have to get the Persian Gulf open. The Chinese and the Americans have been dumping huge amounts of oil in the market to try to stabilize the market, and they have done. People don't understand what an incredible job President Trump's team has done keeping oil prices basically under $110 the whole time. I mean, if you would have talked to 50 oil and gas experts and said, we're shutting down, the Persian Gulf is going to be shut down for 2 or 3 months, there's not one single person that said oil would have stayed at 110, and yet they were able to do it. They worked very closely with the Chinese. I believe we haven't seen anything on this, but the Chinese have really dropped oil demand quite a bit, and they appear to be using an enormous amount of their stockpiles. The United States has shipped huge amounts of oil and gasoline and diesel fuel and jet fuel to other countries. Look, honestly, this has not been a bad deal for the United States. Oil prices have gone up, but we got plenty of oil and gas. We can ship. We have extra to give to other people. Other people don't have that opportunity. And if you look at particularly the Asian countries in Europe, they're in a lot of trouble. Their costs have really gone up. There's shortages. Places like India and Taiwan, Thailand, and places like that, there's shortages of different fuels. It's been a very tough thing. So we had to do something to get this going. We also have to stop the Iranians from using nuclear weapons. And so it's a tough situation, but we've gone back and forth on this. I mean, I feel like I've talked about it ad infinitum as it is already, but we're getting close to getting something done. But what's kind of coming out of it that's a little concerning is really this split, somewhat of a split between the United States and Israel. I mean, it's almost somewhat of a blame game. And a couple thoughts on that. Look, this thing clearly didn't go as expected. And I don't believe the United States was the one that was so anxious to get into this war in the first place and had such rosy, optimistic things. It's not on us. We've done everything we can to help out Israel. And so don't come and blame us when this goes bad on the situation. This has been a tough situation. And so we're trying to get through it now. And so this is causing inflation to go up to some extent. But it doesn't appear to be slowing down the economy as much as anticipated for a number of reasons. But one of them is just a very well managed program by President. Again, I'm repeating myself, but I can't stress enough what an incredible job they have done keeping this oil and gas price down, and so that's made a big difference. And so now we have higher inflation, and we're really looking into the numbers on inflation. We're going to discuss Kevin Warsh, because look, inflation's going up. Longer term, this is forcing bond prices to go up. If this war wouldn't have been here, oil would probably be at $60 right now. We really wouldn't be discussing oil and gas and inflation so much all over the place, and interest rates wouldn't be rising. We'd be talking about interest rates falling, and all would be good in Trump land. And so this has come to a big cost to the MAGA movement. We put a lot on the line on this thing, and but other parts of the agenda is going quite well. The AI build out, the energy build out in the United States, the reshoring of manufacturing to the United States. President Trump, it's almost embarrassing how hard he's always fighting to get more factories and plants to the United States of America. I mean, he's fighting for working people, and all they do is make fun of him every single day. But he is doing that. I mean, he talks constantly about it, and so we have this AI build out. Things are going well in the United States. The question is, how much better is it going to get? And that's going to be, that's the key thing. I think the economy is doing quite well. Working people are struggling out there, and you're seeing it in the numbers from restaurants. You're hearing it from other companies out there that we're having trouble. Where a lot of consumer companies, they're under pressure. They're trying to cut costs. Look, a couple thoughts. If I kick over here real quick, where I got it right here somewhere, and look at a long-term chart of the essence of oil and gas, and what comes out is, for the last 20 years, oil and gas has been trading basically higher than this. It's about $80 now. It's been trading over the hundreds, and it's been kind of the same place the whole time. So I don't believe inflation is oil and gas. I don't believe inflation is being caused by oil and gas. If you just look at the numbers, if you study the numbers, that's just not what things are saying overall. With the market, I mean, if you look at it, if oil and gas is trading basically at the same level it's traded for 20 years, basically up $20 from here or down $20 from here, how is oil triggering all this massive inflation? We should have had deflation when oil went down to $60 a barrel, but we weren't getting it. We're still getting the inflation. And what we believe this is we believe that this is really due to excessive money printing out there by the Federal Reserve and the government, and $2 trillion a year deficit spending over the last 5 years by the government. Basically, we had the COVID came out, and the government just ramped up spending to the highest level since the Depression, or since World War II, and this has triggered a big inflation. Oh, and by the way, Tulsi Gabbard came out and released a lot of stuff on Dr. Fauci in the Wuhan lab. It was pretty much, as we said on this show at the time, and I remember we quoted above anyone else, we quoted either it was a Vietnamese or an Indian study that said, hey, we looked at the COVID virus and the Furlan or COVID, the cleavage site. There's no way that this thing could be, this is a man-made virus at the time. And we talked about it on this show. And I think we did a remarkably good job of warning people about the COVID and then pointing out where it came from. But Dr. Fauci, they were banned from doing gain-of-function research in the United States. He moved everything over to China, and it clearly it looks like it escaped from the Chinese lab. And Tulsi Gabbard, the last day she was in office, released all the information. The interesting thing about that, I don't think that surprised anyone. I think most people knew that and already understood it. It's very sad, that we got ourselves into this situation. It was completely preventable. And but again, it's no surprise. Now, tell you what, let's take a quick break. We'll be right back right here on the MaxOut Savings Show.
The MaxOut Savings Show with Ted Geoca will return shortly. To speak with Ted Geoca now, call 713-339-1070. Back in a moment with the MaxOut Savings Show.
I'm Ted Geoca, and I approve this message.
Inflation, instability of the market, bonds, precious metals, oil and gas, and lack of old-fashioned cash puts your retirement at risk. It takes a different type of portfolio to deal with these issues, and that's where Ted Geoca can come in, and he can help. Go to MaxOutSavings.com and schedule some time with Ted. That's MaxOutSavings.com. And listen to the Max Out Savings Show every Saturday at 10 a.m. on AM 1070 and FM 1033. The Answer.
I'm Sam Malone, president of 512 New Media. We're Houston's leading marketing and content creation firm for many reasons. Our assets are exceptional, from video production to web design, strategy, and the ability to say no. Saying no is integral in launching a successful, profitable campaign. For example, take a look at Memorial Day. It's a federal holiday set aside to honor and mourn those in our U.S. military who died while serving our country. I'll say it again, for those who died while serving our country. So how does having a sale work in unison with the reason for the day off? Look, we know people will be at the beach and barbecuing and having parties. We would probably say no to launching a Memorial Day sale. So is there another way to commemorate the day while marketing your brand? Absolutely. And from our experience, the same holds true with Easter Day sales and MLK Day sales and Christmas Day sales. That's why we're different. No cookie cutter, follow the crowd, template marketing. Let's talk. We're 512 New Media. 512 New Media. With better marketing comes better value, creating better results.
In the 1970s, the big song was the Bee Gees' Staying Alive. Well, it was difficult back then to stay alive if you were a retiree. Inflation was running rampant, and since then, over the last 25 years, it's gone away. Well, inflation's coming back, and it's going to endanger your retirement. If you're a retiree, inflation is your biggest enemy. Hi, this is Ted Geoca of the Max Out Savings Show. If you need help with your retirement, I'd like to help you out. Go to MaxOutSavings.com. That's MaxOutSavings.com, and we'll show you how you manage through inflation. Don't let inflation destroy your retirement.
We return now to the Max Out Savings Show. Here's Ted Geoca.
Welcome back to the Max Out Savings Show. We're talking savings investments in your retirement. We're on YouTube now, and so we're going to start posting our stuff up there. We've got a little bit up there. There's going to be more, and give us some time. The show is, I don't know if it's doing this week or next, but we're going to be running live at the same time, video on the 1070 website, KNTH's website. So a lot of exciting things happening here. So what we're just talking about oil prices. And if you look at oil on an inflation-adjusted basis, it trades basically between $50 and about $90 for the last 20 years. Now, 20 years ago, $90 is a lot different, than it is today. And I don't think this inflation is being fueled by oil. I think oil is an excuse. I think there's two things. If you look at the margins on Wall Street, they're at record high levels. Now, if you're in a high inflationary environment, in theory, the margins should be falling. If you go back to the 70s, the margins weren't that good for corporate America because they were struggling with inflation. But most corporations are so aggressive in raising the revenue or cutting back the size of the packaging to beat the numbers every quarter that they've been raising the price. They're forcing, and then they're blaming oil and gas. And the other thing that if you look at the numbers, and there's a story today in the Wall Street Journal about the people being hit by quote inflation or concern, it's moving up the income ladder. And everyone talks about the price of eggs or the price of oil, but look, that's not my big expense. I drive a lot, and that's not my big expense. Okay, if you look at auto insurance, if you look at home insurance, if you look at medical insurance, these numbers are sky high. And yet somehow they're never mentioned. They have all these charts showing you what the price of college is going up, what the price of this is going up, automobiles, this, that, and everything else. But the insurance continues to skyrocket out there, and they're going to have to restructure the entire insurance business. And so it's margins on it's companies on Wall Street raising prices. I mean, the standard joke about a little package of potato chips having 3 potato chips in it now because the price stays the same. They keep cutting the number of potato chips. And it's like that all over the place. I got breakfast today and the breakfast taco was $1 more. I'm like, what? Where did this come from? And so this is kind of it's happening everywhere, and people are under pressure. But if you talk to the people at the restaurants, I don't think they will tell me, Ted, oil prices are up. I think they will tell me, hey, I'm having to pay people more. They're struggling. My insurance is up for the building. My insurance is up for the business. My car insurance, it's the insurance. And yet somehow this insurance is constantly not mentioned. I really think that President Trump should put together a commission, a panel or something on insurance. He should bring in this is mostly done at the state level, but they should bring in all the insurance commissioners into the White House. Now, of course, New York and Massachusetts and California and Illinois aren't going to show up, but let the rest of the countries, they'll come in and they'll get something done and they'll work to get insurance costs down. This is a real problem. Inflation is a real deal out there and it's getting worse. And inflation is deadly to a retirement plan. And there's just no other way around it. And so, but what I want you to understand, this is not all oil. It's not even majority oil. It's really, it's a lot of other things out there, but in particular, it's many areas. If you look at most of corporate America, it's divided up into different oligopolies where in almost every industry, a couple, 1 or 2, 2, maybe 3 at the most, but really 2 companies are running everything and they're setting price. Look at the margins on Wall Street. Again, in this environment with high inflation, we shouldn't be hitting record high margins. And so this is something to think about. And I think there's going to be more pressure along these lines. Now, big development this week, really big development. Now is the introduction in the first meeting with Kevin Warsh as Federal Reserve Chairman. I didn't hear much about it. He came out and formed 5 panels or task force to look at everything from inflation to how they study the numbers to actually updating the actual surveys and things so they get good information. If you look at it, every single Fed governor has had a different method of doing things. Going back to Greenspan was super obtruse, and they couldn't figure out what he was saying. I think he one time made the comment like, if you understood what I said, then I was too clear. And something along those lines. It finally reached the point where they could never figure out what he was going to do. So then he was walking across the street to the Fed building and he carried a briefcase. So then they studied the size of his briefcase. They noticed if the briefcase got bigger, then there was likely something was going to happen because he was going to present everything to the committee. To the point now where the Fed is like telegraphing 6 months ahead of time what they're doing. So they're so terrified that if they raise rates 1/4 of a point, the market will collapse or the financial system will implode, which is ridiculous. And by the way, when you have that attitude, what you're doing is you're not bulletproofing the financial system. You're creating a very fragile financial system. And I think Kevin Warsh knows that. Again, if you're always telegraphing things out there and the market is always figuring out exactly what you're doing all the time, then if something unexpected, it has no way to react. It doesn't have the cushions in place that, well, we're not sure what the Fed's going to do, so we're always going to be a little more cautious. Overall, if everyone's dead certain on what's going to happen when something that comes out that's out of the blue, that is a huge deal. You want your financial system to be really bulletproof. You want it to be risk averse. You want it to be, so it can take whatever you throw at it without having to sit there and panic. So that's something to watch. So, but Kevin Warsh is going to make changes. They're each different. We had Kevin Warsh. I mean, we had Alan Greenspan. We had Bernanke. We had Janet Yellen. We had, of course, our most recent one, Chairman Powell. I mean, Powell. People forget Powell cut interest rates 2 months before the last election, and then he wouldn't cut rates for Trump. I mean, he's been very political in many ways, and and he was too late in really raising interest rates. They had, people forget, 3 or 4 years ago, we had interest rates at 0.5%. And we said at the time, we even had a chart, I think, when this is 5,000 years of interest rates. And this is the lowest in 5,000 years. Well, if you're at the the third derivative in 5,000 years, there's a problem. I mean, clearly something's way out of kilter, because financial systems don't change that much. I mean, for all the talk, back in the day, they would round off the coins. That's why you got the serrated edges on coins, because they'd put them in a die and make them like a fraction of an inch, less in diameter, and then put out more coins. You can see at times, sometimes if you got like a new silver or gold mine come up somewhere, more would come on the market. Inflation would come out because they used coins back then, gold, silver, bronze coins, those type of things. But you had the emperors doing the same thing. The Roman emperors doing the same thing the Fed did 2,000 years later. I mean, it just, nothing ever changes. And this is why, the fiat system with money, paper money, where you can print more money, is a disaster. I mean, it's been phenomenal for the stock market, because every single time there's the least bit of crisis, the Federal Reserve jumps up. They start buying more treasury. I mean, they buy treasuries, and they started buying corporates, but just in ETFs. Remember that little deal? We were in there trying to buy corporates at the time. Like, why are you doing that? We like them at these low prices because we're getting good deals for our clients. We got money. We're putting it to work. And then we're competing with the Federal Reserve, and so we tend to be bottom fishers. And when things are, we like to take advantage of situations. But even then they flood. Well, this has happened. It happened in it started with 1999. It really was the crash in 87, but 99, it really started up again with at the time in 2001, Ben Bernanke came out and said, hey, if need be, we're not going to allow a depression or deflation. We have a helicopter and we can throw money out of the helicopter. At that time, in 2001, we wrote that this was a 20 or 25-year bull market in gold. And actually, our call on gold in the MaxOut Savings Report, which we send out completely free on this show, completely free, you don't call it, don't bother you, that call beat the S&P 500 for the next 25 years. I mean, think about that. But because we knew that's what they were going to do, and then they did it in 99. They did it in the Iraq War. They did it in COVID. They did it in the Russia situation, Russia-Ukraine war. They've done it every single time there's a problem. They flood the system with money. The problem is people are now wise to what's happening out there, and that's becoming an issue. And so this is why we've had such a huge move up in gold. So Chairman Warsh has come on. He has to change his game. He can't keep doing the same type of thing. And so what he's likely going to do, he's likely going to work on shrinking a balance sheet of $3 or $4 trillion at the Fed. He knows he has to maintain people's confidence in government and in the Federal Reserve, so they're going to be more confident and buy treasuries longer term. So he can't just go start cutting rates and looking reckless. So what he did was, he was very smart. He put out a release. He actually read the release, and someone commented like, this is a very short release. He's like, yeah, we're not going to be releasing a lot. He doesn't want to talk a lot. He doesn't want to give a lot of guidance, but he wants to create confidence. Look, we're not going to go flood the system with money. We're not cutting rates to zero. You can be safe buying treasuries, and we're not going to cause. And he needs to have people think he's going to be tough on inflation. As much as President Trump wants interest rates cut, he understands it's real hard to cut rates with 4% inflation as well. And so Kevin Warsh has some time to do things. So expect some big things out of Kevin Warsh. I think he's going to try to change the game. I still like the 2-year treasuries. We've been kind of rolling the 2-year treasuries. It's been a pretty good way to go. I continue to like it. We might move a little further out on the curve. We have to kind of watch it and sort of see what's going to happen. But you can get over 4% on treasuries. And the other thing, what's different about our firm is we also buy some industrials, but we try to buy industrials that we think in a crisis will compete with treasuries. And it's not always the AAA rated stuff, but it's A rated, it's high quality, it's first mortgage bonds, it's different types of things in businesses that there's not going to be a run on the balance sheet, that there's not going to be, that consumer spending is not going to collapse on them. So what we like to do is we try to buy our bonds to withstand a very, very tough hit from the economy, because we know all we're getting is going to be the interest on the bond. Remember, a stock, you get a dividend plus you get capital gain, but that's not the way it works with the bond. You're getting 4% or 4.4% now for short term with low risk, but you're like, hey, I'm happy with this. It's low risk. If something happens, I know it's going to be there. But that's all you're getting. So our philosophy is, if we can get like 4.4, 4.3 on a corporate, we'd rather have a high quality one than get 4.65 or 4.7 with the riskier one, because for 30 basis or 40 basis points, I don't want to take the risk. When no one cares when they're going up. It's like, hey, you could get 30 basis or 40 basis points over here. Yeah. But when things really go bad and things are really in trouble, and it always happens, there's a crisis strikes. This is our clients' retirement money or trust. It's big money. It's conservative money, and people depend on the money. We don't have a bunch of billionaires riding around in private jets all over the place investing with us. We have people. We manage money for working people. A lot of wealthy people. Don't get me wrong. We got a lot of very wealthy people, but these people, they want us watching over the money, and we're not in private equity. We're trapped in that, like a lot of these quote family offices that thought they were smarter than everyone else, and now they can't get their money out of their private equity investments. People forget Harvard University had a $52 billion endowment. Now, if you got $52 billion, hey, things are good. You don't have to worry about a thing. Harvard went and let the protests against Israel get out of control. They were attacking Jewish students, and a lot of the alumni pulled their funding and said, look, we're not giving you any money. Harvard had to borrow over $1 billion to fund operations because they couldn't get the money out of their endowment because they were trapped in private equity in funds that they couldn't get out of. That's poor planning. That's not knowing what you're doing. That's chasing yield. When you have $52 billion, you don't need to get the highest return on Wall Street. You just need to protect the money, because you're not getting another $52 billion. I mean, think about that. It's just like that's just the way it is. And so what we try to do with our research is we try to look. We do a lot of research. We pay for a lot of. We have research that only big hedge funds, central banks, and sovereign wealth funds get. I mean, that's enormously expensive. But our clients, we want to make sure that they're dealing with the best out there. They're getting the best treatment, and not only when it's going up, but when it's down. They want their assets protected. We can't guarantee anything, of course, but I do think that's when it makes a difference, because that when you need the money is when things sort of go bad, and that's when it needs to be there. And at the same time, it's also opportunity cost. If you've got cash and the sidelines or in stuff that you can get out that's up pretty high and things have collapsed. It's like the comment I made about the bonds. We were buying bonds. What was it during the the COVID? We were buying bonds yielding over 8.5% on high quality bonds. And we looked at the bonds and we even said, hey, if they go bankrupt, we don't even care, because we know the assets backing them is going to sit there and make us good. And so that's what we try to do is look at that. I mean, it's a different way of investing. It's too many people today have fallen kind of into the siren song of Wall Street of, like, oh, you're so sophisticated, you're not in private equity, or it's like, this is where they make more money. This is where they get bigger fees, but you get bigger returns, and you can put part of your money there. I don't have a problem with it. But you want to, when you build up wealth, you don't want to lose wealth. And this is something, and it's not easy to build up wealth. This is, it's kind of easy today. I mean, where everyone's making money, but when, to rebuild it's very hard. And so this is something, we talk to these people in private equity. We talked to, what was it, 22, I think, and like, oh yeah, Ted, our stuff is only, it was the tariff tantrums. We heard from one, we won't use any names here. Oh yeah, how are things going? Well, the markets are down, but we're doing okay. I said, well, how are y'all doing over there? Oh, we're fine. We're down like 2% year to date or something. I'm thinking, how is that possible? The market plunged 15% in a couple weeks, and you're down 2%. There was no way on planet Earth they're down, but they were simply marking the assets and waiting on a quarterly basis and then buying and so you were never getting you're not getting what a true mark is in the market. You're not getting true price discovery because it's kind of a private thing. And that's a very dangerous thing, because keep in mind, you're investing. So if we were to put our clients into that when there was a crisis, we'd be overpaying for private equity. So this is just something to think about overall with your investing. Oh, tell you what, we're up against a hard break here. We'll be right back right here on the Max Out Savings Show.
The Max Out Savings Show with Ted Geoca will return shortly. To speak with Ted Geoca now, call 713-339-1070. Back in a moment with the Max Out Savings Show.
I'm Ted Geoca, and I approve this message.
MaxOut Savings is looking at rising interest rates, the bond market, and our country's spending to project the impact on your retirement. They use that data to help you flex to current conditions with your future in mind. Call 713-627-0400 to learn more. That's 713-627-0400 or maxoutsavings.com. Remember, you can hear the MaxOut Savings program right here Saturdays at 10 a.m. on AM 1070 and FM 103.3. The Answer.
Hi, I'm Sam Malone, the owner of Houston's cutting-edge media company called 512 New Media. At 512 New Media, we create amazing videos that companies use on their websites, telling their story in bold colors with exciting animation and graphics. At 512 New Media, we also shoot television commercials and instructional videos. And if you want to show off your business from the air, we're ready to go with our drone video aircraft. Let us help you create your media message. We're online at 512newmedia.com or call 281-822-8803. 512 New Media is Houston's only media creation and distribution company that's actually owned by someone who's currently on the air. And that gives us an incredible edge when creating content for consumers to use on their laptops, tablets, and smartphones. Standing by to create your message, we're 512 New Media, 512newmedia.com.
This is Ted Geoca, host of the Max Out Savings Show, one of Houston's most popular financial radio shows, celebrating over a decade on the air in Houston, Texas. With stocks at record high valuations and interest rates near record lows, you need to have your guard up. You need to have a plan to manage risk to your retirement. Do you? At MaxOut Savings Advisors, we have a risk-based value investing approach to your retirement. If you would like some help managing your retirement, go to maxoutsavings.com to set up an appointment. That's maxoutsavings.com.
We return now to the Max Out Savings Show. Here's Ted Geoca.
Welcome back to the Max Out Savings Show. I'm Ted Geoca. We're talking savings, investments, and your retirement. We actually was just talking to a client, texted me. They're like, Ted, not only is my insurance going up, my groceries, everything's going up, and Social Security has not gone up. And this is really the problem out there. And this market going up the way it is has really kind of hidden a big problem out there with retirees in general across the board. Is things are going pretty well in the market, and so it's not these are not, you're not always going to get these big returns. We've had incredibly good returns the last couple of years, but that's not always going to happen. And so as the market falls or it doesn't go anywhere, that's going to put even bigger pressure. So understand that this inflation is a big deal, and this puts a lot of pressure on Chairman Warsh. So I think you're going to see some interesting things. We're going to be talking some more about this. I think he's going to work a little outside of the box in here. I think they're going to try to make people more comfortable about investing in treasuries. And he's definitely, there are much bigger changes coming up at the Federal Reserve than people understand right now. And I think there are going to be a lot of positive things out there, because I think these people are now understanding you can't just keep flooding the system with money. Now, things have changed over time. It used to be token was basically, smoking a joint or something. And now it's gone to the most expensive thing on planet Earth, which is AI tokens. And so I came across the story here, and there's a big battle between the United States and China. We have to have we've got the best and the fastest AI out there, and we've got to beat the Chinese. And we're building factories, we're building AI facilities, we're building chip plants and everything else, because we've got to be ahead of the Chinese. That's not correct. Okay, that is not correct. We need to be cost effective ahead of the Chinese. If we've got the most greatest system in the world and it costs a fortune to run, the Chinese are going to destroy us, because their cheaper system might not be quite as good, but it's going to be a whole lot cheaper. And so this is something that's going to come out. If you look at the price of bear with me on this, of the GLM 5.2 system by ZAI, the price for input and output tokens, per million tokens, is $1.40 to $4.40. So the output tokens are more expensive. If you look at the Claude Fable, it works out to be about $10 to $50. And so that's a lot. It's 1/10 of the cost of the system. Now, the problem is the GLM-5.2 is the ZAI is a Chinese company. And it's a reasonably good system. It's a very good system, but it's 1/10, 1/8 of the cost of the American system. And this is a problem. And so the question is, how much, all these AI centers, all the build out of this is prefaced on all this massive demand for AI. So the hyperscalers are building out, Google, Meta, and Microsoft, Amazon, NVIDIA, Oracle. They're all building these things all over the place. But Grok, SpaceX, all of them, they're going to put one in outer space. But the problem is these are expensive systems, and the Chinese are coming in underneath us. Now, electricity in China is about 7.9 cents a kilowatt hour, or 4.4 cents a kilowatt hour. In the United States, it's about 7.9. So there's about a 40% difference or more, actually, in electricity cost. But the Chinese, one of the things the Chinese don't have the NVIDIA Blackwell superpower chip or the latest one that's coming out. They have to deal with less powerful chips. So they're having to be much more efficient with their coding and their operation. So they want to have a real efficient, and they don't have a real good system. And so they're getting more out of their systems, which is making the cost cheaper. And so this is something we want to kind of continue to watch here and see what's going to happen. But I want you to understand that it's not just the speed and the power of the system, but it's also the cost. I think we have a call from Charles. Charles, you there?
Ted, can you hear me?
Yeah. You had a question for us.
Okay. Yeah. Earlier you mentioned about paying $1 more for a breakfast taco, and I just wanted to get your thoughts on this minimum wage business, because it seems to me that I know they haven't addressed the minimum wage here in Texas, but I listen to the mayor in New York and all these places that they want to raise these minimum wage rates. And to me, I think and I mean, there ought to be a minimum wage as such, but the problem is when they raise this stuff, a lot of times they put handcuffs on the workers. And to me, I would think the restaurant business would be the first to really, really take it hard if the minimum wage was raised. I look back on when I went to eat at a Red Lobster many, many years ago, and it was a waitress that waited at our table, and she was about ready to leave, and I said, well, I guess you're glad that you're leaving, to go home. And she says, no. She says, actually, I wanted to work longer hours, but they only allow me to work 30 hours or 35. And I said, oh, I think I know what the reason for that is. And she says, what's that? I said, because if you work longer, if you work 40 hours, then they have to pay you health insurance. And she just kind of looked at me, and I thought, this isn't right for these workers. They're working their hearts out, but then they can't get the benefits. What are your thoughts on that?
Look, I think that the minimum wage is a big issue. I think it has to be reasonable, but I think it's in my sister's from Seattle, and I think the minimum wage is like $25 up there, or 30. It's some ridiculous. It's 25 at least, and she comes down here and can't believe how cheap everything is. She thinks she's like in Mexico or something, and it's just it's a huge difference. They don't go out as much up there. They're pretty well off and stuff, and so it completely changes the game. Look, this is a real problem. They're going to have to, like I said, I really believe they have to start going after insurance. All of these things have just gotten completely out of control, and nobody wants to look at them. They just want to blame the oil and gas industry. And as I said earlier in the show, oil and gas is trading about the same place it has for the last 20 years, even at $90 a barrel. About the same place. So how is oil not really moving in 20 years, causing all this inflation? The answer is it's not. It's insurance. It's actually minimum wage type of stuff. Those type of things are really, I don't know what's with the phone today. Those are all really causing big issues with inflation. And so this is something they're going to have to deal with it. And the second thing, Charles, is really, I think corporate America is, quote, taking advantage of, quote, higher oil prices to continue to raise prices because they're under so much pressure by Wall Street to hit their earnings numbers. And our margins are record high levels on Wall Street is what the margins are at. And so I think you're going to see big changes. I think Trump is going to get involved. I think as this election gets closer for the congressional elections, they're going to become much more populous. And so we have to look forward to that. But good questions. Thanks.
Okay.
This inflation is just this seems to be everywhere. And but again, it's a lot of different things. So that's what we're dealing with. Question. What we're looking at now is a couple things. The question is, if you look at some of the things like actually the consumer stocks, if you look at the medical stock, they're way down in price. I mean, we almost bought a medical stock here Friday. We were in there buying some bonds for some people, but they're starting to turn up. The question is, does the market broaden out? And even if it doesn't, there's so much money piled into AI. I've seen numbers. It's probably at least 45% is in AI stocks in the S&P 500. That's a pretty enormous amount. There's going to be a lot of money made on this build out. There's probably going to be $1 trillion for the big AI spenders in 27 and 28 too. But there's going to be some winners and losers. And I've said on the show, you got 5 companies, the Mag 7, but really Apple, Microsoft, Google, Amazon, Meta. Those are the big ones. Those companies all have moats around their businesses and they're huge cash flow machines. Every one of these people. These are the numbers that they borrowed here recently. NVIDIA just borrowed $25 billion. Just this week, Amazon borrowed $14 billion in Canada because they're having trouble getting more money here. If you look at $550 billion is the borrowing and spending that's going to come out of Meta. If you look at Google, $900 billion worth of borrowing, $500 billion worth of borrowing from Oracle. All these that doesn't include some of the others. Enormous. We don't know who's all going to be profitable in this game right now. Before each one, look, Meta sat there with Instagram and Facebook. Nobody could touch them. If you look at Microsoft, they had an operating system. I've said it before and I'll say it again. In the future, you're going to have an AI device. There's not going to be any apps. The AI is going to handle everything for you, and it's going to make your data private for yourself, and it's going to stop all these companies from stealing your data. I mean, I'll be first in line to buy it because everybody is trying to find out what I'm doing 24/7. But all these moats these people have, if you look at Google, they had 80-90% of search in this country. So anytime anyone wanted to look around and figure out what was happening, Google knew about it, and they had this huge database they were making a fortune off of. That was not in your best interest. With AI in the future, they're going to be monitoring you. And if they see Ted coming along, and they go, well, Ted's making a little more money this year, so we can charge him more than we did last year. Or, Ted lost his job this year, so we have to cut it, which that might be a positive in the cutting the price. But that's the type of thing you're going to start seeing happen, dynamic pricing in the world where everything is dynamically priced. You don't want anybody knowing who you are. And so there's a lot of changes that are going to be happening in the world. And so if you look at these big, NVIDIA has not really gone anywhere this year. A lot of these things haven't gone anywhere this year, and they're kind of selling off some. So I think what we're seeing is, I think we're going to see, continued chop in the market, a lot more volatility in this market going forward. We just brought the SpaceX deal. There's going to be more selling of SpaceX stock. There's going to be more people investing in it. That's pulling money away from the other AI companies. They're going to be Anthropic, OpenAI behind them. And there's at least 100 to 500 more IPOs they'd like to do in here. Huge supply coming on the market. So you want to be a little cautious in here, and you want to continue to spread that risk out in the market and protect your IRA. A couple things. If you need some help, go to our website, MaxOutSavings.com. That's MaxOutSavings.com. You can sign up for the free MaxOut Savings Report. We write a lot about these issues. We try to get you ahead of what's happening in the world. It's a completely free report. In addition, you can also go and request an appointment to meet with me here in Houston, Texas. We manage retirement money, trust, big money, using our value investing approach to the stock and bond markets. We hold most of our assets at Charles Schwab. They're the custodian, and we just operate through them. But and we use our value investing and risk management approach. So if you need some help, go to the website, you get the phone number or the email, drop me an email or a phone call, request an appointment. We'll sit down with you here in Houston and see if we can help you. I'd like to help you out if we can, and show you how we manage money. It's MaxOutSavings.com. And remember our motto and philosophy, which is the key to building up wealth, and it should be yours too, which is to save aggressively and invest conservatively. As we talked about at the beginning of the show, if you're behind in savings retirement, now's the time to take charge of it, increase your savings in your company plans, put away that money, build up that wealth, and change your life. I hope everyone has a great weekend. We'll see you next week right here on the MaxOut Savings Show.
This has been the MaxOut Savings Show with Ted Geoca, a presentation of MaxOut Savings Advisors. Join us next Saturday at 10 a.m. for the MaxOut Savings Show with Ted Geoca on AM 1070. The Answer.